What are those one or two or three or top three options for the first time fund structuring that we are looking at?
I would say it's a rule called the KISS rule, which I was trained when I was again, a very young attorney. Keep it simple, stupid. That's the KISS rule. And it's true. Most firms that you're building are going to fit a simple paradigm of a structure. I don't know if I could share a screen. I could even pull up the structure chart if viewers be able to see that. In designing an investment management firm, a venture capital firm, a private equity firm, what have you, the structure chart that you're seeing here is, to me, the elemental and 9 times out of 10 optimal structure. Your question was an interesting one, Rakesh, in terms of let's talk about how to design a first-time fund, and then let's talk about how bigger funds, how more institutional funds may be structured differently. And what I would interestingly probably say to that is 9 times out of 10, they're the same.
Hmm.
In other words, larger funds don't tend to become more complicated in structure. There are deviations from what I just said. If you have a lot of investors coming from Europe and a lot of investors coming from Asia and a lot of different types of investors coming from different global, jurisdictions, there may be tax reasons and other reasons why investors would be comfortable with different types of entities to come into. So you may have a Luxembourg entity and a Irish entity and different things for different types of investors. But most of the time, especially unless you're raising like some mega $10 billion private equity fund, if you're raising a $500 million middle market, lower middle market PE fund or a $200 million venture fund, the structure chart you're looking at is 9 times out of 10, maybe 9.9 times out of 10, going to be the starting point and the correct endpoint. The big picture is the fund starting at the bottom of the page. It's a Delaware limited partnership. Sometimes clients come with preconceived misconceptions, I would say. Well, I'm going to take some money from Europe, so I need an offshore feeder. KISS, keep it simple. Keep it simple. 9 times out of 10, that's not necessary. It doesn't give you anything. It doesn't benefit the investors and just adds cost and complexity to the structure. Non-US people can come into a Delaware limited partnership.
Yeah.
Okay. That's at the bottom. That's the fund. No parallel funds for the most part. Again, we can double click why a parallel fund may be helpful. No feeder funds. We could double click why a feeder fund may be helpful. But 9 times out of 10, it's a single Delaware limited partnership. And now we're thinking, okay, we built the fund design wise. What about the firm? What about the entities that the founder and his or her partners are going to be forming to manage and own Fund One and future funds? And that's where these other three triangles come in that you see here. I call this the diamond structure for obvious
Yeah.
reasons. So the fund is at the bottom, and that's where the limited partners invest directly. But then you have a general partner up to the right. That's the entity that will manage the fund technically under Delaware law and also receive the carried interest, the profit share on investor dollars. That's unique to this particular fund. So Fund 1 has GP1. Fund 2 has GP2. Sometimes clients come and they want to cross their GP across different funds. And I advise them against it because the GP is the entity that, at least technically in Delaware, holds the residual liability for the fund. The general partner of a limited partnership, the fund being a limited partnership, the general partner, meaning this entity, does not have the benefit like the limited partners, like the investors do, of having limited liability. So we don't want to ever cross revenues and liabilities from different funds into one entity if we can avoid it.
Makes
On
sense.
the other side of the page here, we have the management company. That is constant. That will survive Fund One and manage all of your funds. That's the entity that has the management fees running to it. That's the entity that has the expenses. So overhead, employee, office, supplies, all that stuff is an expense of the management company. That's why the management company, the management fee goes to that entity. Then I have some clients who say, wait a second, why can't we just merge the GP and the management company? Why can't I have management fees and carry go to the same entity? And I harken back to The same reason why we don't even want one entity to be the GP of more than one fund for liability purpose, limited liability protections. You certainly in spades don't want one entity, your going concern, to also have the residual liability as a general partner of a fund.